Hey, I'm Richard Matthews. I run a wealth management firm in downtown Greenville and Fountain Inn, South Carolina. I've shot tons of videos on market trends, planning strategies, and financial education, and honestly, at this point, I've just talked too much. I'm bored of the sales pitches I hear in financial media, so now I'm interested in what other local financial experts are thinking about in the upstate South Carolina economy and markets on the No Nonsense Investor. All right, so we're here at Cucina 100 in Fountain Inn, and again, we want to thank Cucina for letting us use their space. Y'all are awesome. If you're in Fountain Inn, come to Cucina. Place has really good food, really good drinks. But today we are here with Dennis Germaske, who is kind of new to the area. And Dennis, at this point, I kind of know who you are, but why don't you tell everybody, who are you?
Well, I've recently moved here from Florida about 5 months ago. It became too hectic, too many people flooding in from everywhere. One of the things I've noticed in my 6 months here is the vibrant economy in Greenville, Spartanburg, around the area. I have not been down to the whatever the other part of the state is called, as opposed to up country.
Oh, Midlands, yeah.
But I can say that this is a vibrant economy here. I'm probably going to have to move. They're going to build more roads and more housing.
Lose the countryside.
It really is interesting to note because I simply didn't know much about upcountry South Carolina, obviously. But the industrial activity, commercial, but more industrial activity, surprised the hell out of me. It's really vast within this geographic.
We're very lucky to have the Charleston port have a direct rail to the inland port.
Exactly.
And so you go up 85 and you have Charlotte, you have down south in Atlanta, so it's Charlanta is what it's known as. And so we get the Michelins, the BMWs, the Grangers, all of the manufacturing, ZF. And so BMW was a huge investment because they brought a lot of their suppliers around our area.
Sure. Thousands of suppliers that
and we were able to convince them.
And those are all small to medium-sized companies that hire only 10 to 200 or 500 people, but you
keep adding
500 of them and they count up, they mount up. And that's the long and short of why I'm here.
Nice, very good. Well, we're glad to have you here, and this place is growing, but apparently not as bad as Florida. Walk us through kind of what you did along the career path.
Yeah, happy to do so. After graduating from college, I moved to California to make my fortune and to see beautiful golden California, which has changed unfortunately so much, which is another story. And eventually, in about 10 years post-college, I drifted into a specialty that I stuck with for the next 30 or 40 years, at least through my retirement. And that is financing projects, programs, companies, transactions, generally on the upper end of the financial scale. And I did this mainly in the US and in Europe. My function really, as I saw it, was to take a somewhat complex financing situation and figure out a different way to structure it and bring in multiple parties as opposed to perhaps one or two parties or even one party to finance it, either with equity or with debt. So in a sense, I've been accessing capital markets globally for the last 30 years of my career. And I found it to be fascinating. And in connection with an undergraduate degree in economics and a postgraduate period of time, additional economics courses, I have found that macroeconomics has sort of been my North Star in my life. Not always knowingly, but always there, giving me some input as to what I should do next or what I shouldn't do next. And after retirement, I've focused more on looking at the situation that the U.S. and the globe actually is in from a financial stability point of view, and I'll simply say I'm quite distressed at what I see happening and what I believe will be happening in the next few years.
Yeah, and we're definitely going to discuss that because I think we share very similar beliefs on that. Before we do, walk me through in that 30-year time frame, what would you classify as your favorite deal?
I like to believe that I can bring in various disciplines into a structure, finance, international, tax law in various countries, multiple countries, and I think Amico Canada is probably the most interesting to perhaps others, and certainly was to me. There was a tax law in Canada. This is about 20 years. No, this is about 35 years ago. There was a tax law in Canada that had just been enacted that allowed equipment and real property to be treated with a special benefit, a tax credit, not an investment tax credit, but a tax credit, should their financing be called an operating lease, whatever that means in the various countries. So knowing that, and with the other knowledge that I had and experience that I had, I brought together a major bank. At that time, as I recall, it was Manufacturers Hanover, who they don't exist any longer. Amico Canada was what turned out to be the lessee in an operating lease, which therefore allowed them to take the lease payments and take a credit against their total tax bill. Marvelous, very, very significant benefit. The problem was how to take a $30 million Canadian North Shore drilling platform and make it an operating lease. And the technique that I settled on was to use financial guarantees from Lloyd's Insurance, Lloyd's brokers in London, obviously. And we structured this $30 million deal to be a sale and leaseback on a 3-year period, despite the fact that the life of the drilling rig would be something on the order of 30 years. And we allowed them as a lessee to walk away at the end of 3 years, despite financing 100% of this as a lease. So none of the money came from Amico Canada. And the ability to walk away after 3 years was insured or guaranteed to the lessor, which was Manny, it was Manny Hanny, I'm pretty sure. And that allowed them to get the investment credit for their 100% of their rent payments. The alternative would have been to have the asset on their books and take depreciation on it and get the normal tax treatment. So I felt that brought together the various number of parties to a very excellent structure. And that's how I view myself, as a person who would come up with structures in a complex international financial marketplace. And of course, all during this time, I accessed capital markets, both debt and equity, and therefore, now that I'm retired and I'm looking at things more broadly, such as U.S. Treasuries, which I'm sure we'll talk more about, I have been able to have let's call it, in my opinion, an educated view of what's happening to our country at this time. And at this time, I'm also out of breath.
Yeah, I'll jump in. That's all. I'd heard a little bit of that story before, but basically you were creatively able to, instead of doing a deduction, offset with the credit and make it valuable to everybody involved by insuring a portion of the asset instead of taking the risk at full equity, which...
Yeah, and can I just elaborate on that?
Yeah.
having Lloyd's insure against the fact that only, let's say, 30% of the capital cost of 30 million had been recovered in the first 3 years, why on earth would they do that? Well, the answer is that there was no option for Amoco Canada other than to use that, if not for 30 years, certainly for 20 or longer. And 20 years, at which point there'd be a zero risk and a full return of capital plus profit to the financing source. So they were taking a symbolic risk, an accounting risk, but no real practical risk. And they charged almost nothing for that, creating the ability to effectively be equity, taking an equity risk in place of real equity.
Right.
So, well, that's all I need to say about that, I suppose.
Yeah, that's awesome. That's a cool deal. I've heard a couple of your others in lunches and times we've hung out, and full of awesome stories. That's a great one. But I do want to dive into the main substance of why I said, hey, Dennis, let's do a video together. And I kind of alluded to this on one of my market update videos. I find the fact that I met you in your first 5 months here in the Fountain Inn, Simpsonville area, just interesting, pun intended, by the way. We are, walk us through this paper that you put together in 2016. I agree with, I mean, it's simple math. This is very simple math, but walk us through what you envision as far as the U.S. defaulting on its sovereign debt.
Yeah, delighted. It's a very important topic to me, and one which I have found is not music to people's ears. When economists that I know and others that are in the financial markets seem to not wish to respond to it because it got such a dreadful ending. I believe that I call it catch-22. We are in and I'll explain why in a moment. I believe we're in a position now where with 30 trillion plus of debt and interest rates having been low for more than a decade, and by low I mean approaching zero, it has caused the players in the marketplace, the producers, to favor debt financing over equity financing in the traditional sense, going back 100 plus years. And what we have now is a situation where not only the U.S. Treasury and the United States of America, but corporations are all over leveraged to an incredible degree. And because interest rates have been held so low for so long, and now, only now because inflation has reared its head again after many years being absent, we have a situation where interest rates are being forced upward. The Fed is being forced into a corner to start to allow interest rates to increase. And when interest rates increase enough, which is not too far in the future and not too many basis points in the future, corporations will, before the U.S. government on their treasuries, find that they, or a group of them, those that are most over-leveraged and have the weakest markets in whatever period we're in the next few years, to bankrupt the company, not to be able to roll over that debt, which has been the standard technique for the, as far back as you want to go for corporate bonds. So I believe there's going to be a catastrophic event for U.S. corporations, particularly those on the spectrum of high leverage, coming up very shortly. And I think it will accelerate the same effect on the U.S. Treasury and their bond position. The Fed's balance sheet is, I guess, up to $9 trillion at this point.
Just under.
Just under. Okay. Well, I know you're precise. I tend to broad brush these things, but it's not a bright future. It's a very gloomy future, and it's perhaps I'm only able to look it in the face because I don't have a dog in the fight anymore.
That's a fair point. I think that the corporate debt piece of that is pretty interesting when you're really considering, if we're in an inflationary part and we're going to raise rates and lower demand, then that's going to have an effect on margin as well as on cash flow. And so if we have to continue to roll debt and continue that leverage towards equity and assets, they're pinched. I mean, there's not enough revenue and margin to start covering it.
And may I insert, rolling the debt is a requirement, not an option.
To a higher rate.
Yeah, and if they can't attract, given their general situation and their marketplace, if they can't attract a rollover, they have to basically declare bankruptcy.
Yeah, there's another piece of this that I'm probably down a rabbit hole, but when we're looking at this, a lot of this debt went to fund stock buybacks for a lot of these companies. And so what that did to their equity and their balance sheet just in general, like you said, it's debt financing instead of asset financing, and they're stuck. And the corporate piece before the U.S. piece is a very interesting take on it, and we're not giving advice here on how to play that piece of information, if you even believe it. Yeah, but now, assuming that is correct and that has its own issue in the equity markets, what happens to the U.S. debt? Like, what is the problem with the U.S.? Because the modern monetary theorists out there like to say, well, it's sovereign debt. We can have as much as we want. We can print as much as we want. It's sovereign debt. So walk us through where that becomes the main issue.
Well, it is indeed sovereign debt. The only problem is if you don't pay the interest and you default, you have a catastrophe.
Yeah, that sounds like 101 to me.
Yeah, I mean, exactly. And they prefer to say 1 and 1 is 3 instead of 1 and 1 is 2.
Yep. So what does that look like, the interest?
Just a quick comment on what you're saying and reinforcing it is, the buybacks, the stock buybacks, basically they were mainly purchased back with debt, not with net worth.
Right. Yeah, the opposite.
Yeah. Go figure.
Zombie corporations, I think you can hear them called in the financial media. So
no, I didn't know that.
Yeah,
I'm incredibly uninformed.
Obviously.
Well, I have deep feelings on basic issues, but I don't keep up with a lot of things. I have certain people that I watch, and generally my sons will tell me that I'm out of date and I don't know what I'm doing anymore. Yeah, I have some. Yeah, that's right. Okay.
So who are those experts? Who do you like to watch or listen to, and who are you kind of sick of hearing about?
I have a little trouble naming specifics, but what I object to is listening to talking heads with true backgrounds of experience and knowledge and education give non-answers or evade answering direct questions. It's very difficult for them to face the reality. And I think the only reason, again, that I can is that I don't have a dog in the fight. So that's what really irritates me. Now, more specifically, on a positive note, as I think I've mentioned before, Milton Friedman is and has been since the 60s my hero. And anybody that most people would know him that are in the financial or economics area, but I always love to think about what he accomplished in the country of Chile after the revolution and everything was upset. And I won't get into that at all, but I refer people to look at that part of his history. It's quite interesting, the result that his thoughts and theories had on Chile for a number of decades after he was there and then departed. But of course, everyone knows that he's a monetary theory fellow, and printing money is the worst thing in the world, and I totally agree with him. I think that the Fed, on balance, over the decades and the centuries, or some more than a century that they've been in existence, have done a poor job. And I don't see anyone, I can't see how anyone can argue in their favor if you do any significant detailed reading. So they're my pet bugaboo, and what they've done with interest rates. In fact, one of the Fed governors, they sort of changed positions while they're involved with the Fed. A fellow named Lasker, I believe, about 15 years ago, when quantitative easing was first being bandied about and then put into effect, made a comment that I'll misquote, that if you start this, you may not be able to finish this.
Wow.
Now, for a statement like that in roughly 2006, even before the junk bond problem, subprime mortgages, to say that early is very, very astute.
Wow.
And what he said has turned out to be true, because the Fed has two choices: either keep interest rates low by creating more money supply, or not. If they stop doing that and interest rates go to market, there's going to be catastrophe in the corporations and in the U.S. Treasury, defaults. But if they do keep interest rates low and they keep adding to the national debt, we were at 15 trillion roughly 8 years ago. We're at 31 trillion now. And if they continue not allowing interest rates to rise, which is a disaster if it happens, then we'll continue to have 35, 40, 45, 50 trillion dollars in debt. So the show would stop somewhere.
Right. We'd keep kicking the can by just creating more debt and money, but we're still able to pay for it out of our annual budget
Still now,
because the rates are low enough.
Yes.
But at some point, you either run out of the ability to create debt, or you've raised interest to the point where you have to default because of the budget.
And in the last year, roughly, I'm always wrong on these dates, but roughly the last year, we've gone up from below 1% on two-year treasuries to 3%. Now, if the 3% goes to 5%, the game's over.
Yep.
If they don't go to 5%, then we'll keep printing money.
And having more inflation.
Yeah.
Which I think Jay Powell will readily admit is a bigger risk than the recession.
Despite the fact that he has, before he was the Fed chairman, as a member of the Fed at a lower level, the governor or president, both exist, been in favor. So he talks out of one side of his mouth that he's against it, but he ends up voting for it consistently.
Yeah, but there's no politics in the world of finance. So, interesting. If just to walk people through this that may not be tracking, I mean, if we're at 30 trillion in debt, which is a crazy word to say, 30 trillion in debt, and we're paying next to nothing in interest on it. I think in your paper it was roughly 300 billion per year of interest, which isn't much money in grand scheme of things. Yeah, compared to trillions. But as we raise interest rates, we're potentially talking about, was it 1.5 trillion of just interest payments?
That's what I believe we will be in FY23 in the budget. They will have to recognize that we're now not at 0.5% for two-year treasuries.
Yeah, effectively.
We're now at 3%. So we're halfway to Armageddon.
Right, definitely. And
and where we are now at 3 will require, if honesty is allowed, to have in our budget not 300 billion, but over a trillion. And we don't have that money, so it's got to come out of discretionary spending. It shouldn't come out of non-discretionary spending, pension funds and
social and Medicare,
Social Security and Medicare. So it's got to come out of the smaller slice of the pie that's allotted to discretionary funding, and there ain't no room.
Yeah, well, now you're getting into politics because you're talking about cutting some benefits, cutting some departments.
Why the Fed will not be allowed to raise interest rates enough to yada yada yada.
Yeah, so it's a pinch point. There is no that you called it the catch-22. There it is.
Yeah.
So completely.
Which for those that don't know means that there's no solution.
Right, it's over. I mean, we're past the point of no return. Right.
Yep.
So with that, that was the gist of really what I wanted to cover, and we can get into more details if anybody's really interested in that. But the challenge question, right? We have a challenge question we ask all
Oh,
of
wait.
our.
Looking at
What's that?
this list here,
Uh-huh.
what experts do you follow and which do you get sick of? We haven't covered get sick of.
I thought you were saying Powell and the talking heads that
No,
wouldn't
he's a
answer.
minor
Okay.
irritant to my mind.
So who's the sick of?
Paul Krugman. Oh,
I can agree with that. Why?
he is never, looking back over all of his writings, he's never been right. Oh, you say I'm wrong? Okay, look it up.
So my opinion is that the euro collapses. I feel with what the European Central Bank has done for negative interest rates, just now coming back to zero, the transmission
Isn't that
protection
amazing?
Instrument, which is
Isn't that just amazing?
it's hard to think about, honestly, but we're back to a reality that's still ridiculous, and I feel like with the energy crisis, you just hit on it, that Germany will be feeling because of the pipelines and the green initiatives,
And they have it coming.
yeah, this has been earned. I mean, this is a consequence.
Promoting, over the last 10 years up until this year, promoting the Nord Stream 2 is the stupidest thing that a country has ever done to themselves.
Well, the premise is,
and-
can't we all just get along? I think that was the naive
Exactly.
policy that got them
So
into
now,
that situation.
now that reality has hit them in the face like a wet fish, they're saying that will not be put into operation. And now they're firing up their coal plants again. Oh my God.
All-time high prices on coal. Good job, ESG.
Yeah. It just boggles my mind. However, I'm delighted.
Sure, that's reality.
The fact that of Ukraine is a terrible, terrible catastrophe, of course, human catastrophe. But what it did was it outed Germany
Yeah,
on the fuel issue.
definitely. And if they're the
And the green
economic
issue.
engine and they're supposed to bail out Italy and Portugal and Greece and Spain, then who's bailing them out? And that's why I believe that ultimately Germany starts the defragmentation that Christine Lagarde is so averse to. It was the policies that generated it. So when the euro collapses very soon, I believe, how do those currencies for the franc, the mark, the krona, how do those come back into a real world of a currency market? Or is it just over and everybody's moving to the dollar?
Well, that would be historically what happens if we think about World War II, for example. But the US dollar is in such a situation, given interest rates rising and inflation and all that we've been talking about.
Mhm.
I don't know that their escape hatch is the dollar. If we're thinking, say, 2 or 3 years out, I don't know if there's an escape hatch left to them. They may be in a catch-22 worser than ours. That's a new word.
Yeah, I like worser. I knew what you meant.
Yeah. So will the dollar be available for them to come back to? Is my question. Because they'll have to go somewhere. I don't know where that is.
I don't know.
And let me just throw in a wild card. China is the big bad ogre, and their economy is booming, et cetera, et cetera. Well, I don't happen to buy that. I think that China has some unspoken, very, very severe internal problems. And I'm not going to get into it because it would take too long. But I believe that they will not represent a haven either, even if you close your eyes to the fact that they're led by a Communist Party politically. So I don't know what the hell's going to happen.
Yeah, that we could save that for next time to dive into China, because I agree with that.
Let me add, the market increase in the last month, as far as I know, which has been significant, big time increase. Nobody predicted it. No one that I've heard of. No one even knows why it happened, looking backwards over the last 30, 45 days. Everything is so screwed up that you can't use any of the time-tested value points to come up with an opinion that will turn out to be true.
You could put this in the world of you're coming from a 0% interest rate. Any movement, like starting from a stoplight from 0, is going to be an infinite gain immediately, and that throws all the valuations out of the discussion. So we'll definitely, I definitely want to get you back on here to talk more, because all of these little threads we could dive into for hours. But that's all we got for the No Nonsense Investor. I want to thank Dennis for joining me. It was a great conversation as always. We'll be sure to have him back here. But our hope each week is that we can bring you some information that's helpful for you right here, right now. We're in the upstate. We focus on the economy here in the upstate, but obviously global and national news affects us as well. We want to talk to experts instead of salespeople, and Dennis definitely has done that today. Follow us around the upstate, and we'll bring you some more No Nonsense Investor next time.